There's a growing problem in the housing market that few are talking about because it's uncomfortable to admit and terrifying to recognize. We're surrounded by homes that look affordable on paper, that seem reasonable on Zillow or promising in a glossy listing, but beneath the surface, they carry a weight most buyers won't see until it's already crushing them. Because the sticker price is no longer the real price. The sticker price is the decoy. The real cost is hiding out of sight in the location, market fundamentals, taxes, insurance, maintenance, the migration patterns, debt, and the fragility that no realtor brochure will ever mention. We have homes today, entire neighborhoods, even whole cities, being valued not based on economic foundations, but feelings, narratives, hype, and in some cases, pure speculation. This is overvaluation. This goes beyond prices are high or the market is expensive. These homes are priced far beyond their long-term intrinsic value, the value supported by wages, employment, local demand, and sustainable fundamentals. And why does this matter? Because market gravity always returns, whether slowly, like a fade, or suddenly, like a drop. When homes are overvalued, the people who buy them face a triple risk: financial risk, emotional risk, and opportunity risk. Financial, because if the market corrects, equity evaporates. Emotional, because homeowners become trapped, unable to sell, unable to refinance, unable to move. And opportunity, because years of savings can be frozen inside an asset that is drifting downward. Overvaluation also reshapes communities. It locks out first-time buyers. It pushes renters into corners. It fuels dangerous borrowing decisions. It destabilizes affordability for almost everyone. And yet somehow, many markets today are priced like demand will rise forever, even while population declines, jobs stagnate, and insurance companies quietly back away. Tonight, we're going to uncover why this is happening, how to recognize it, and what it means for the years ahead. Before we dive in, be sure to hit like and subscribe to Housing Data Lab so you never miss any real estate realness. And leave a comment below if your on-the-ground experience lines up with our findings or totally deviates. Let's get started. You might be wondering, how do we even know a market is overvalued? It's not just a gut feeling or some journalist's hot take. Economists and real estate researchers actually have tools for this. They don't just eyeball Zillow listings. They crunch data, compare it to long-term trends, and expose where prices are dangerously stretched. One of the most influential studies comes from Florida Atlantic University and Florida International University. Their top 100 U.S. housing markets research uses publicly available Zillow data to build a statistical model of what home prices should be, not what they are today, based on decades of price history, local trends, and long-running patterns. Here's how it works. They take the actual average selling price in a metro area, then compare it to a predicted average price calculated from the city's own historical trajectory. That trajectory is shaped by long-term factors: prior home price growth, inflation, cycles, and other fundamentals. The gap between reality and prediction is called a premium, and that's how they quantify overvaluation. For example, Benzinga reports that according to this model, homes in Detroit are trading around 40.79% above their long-term trend. In Atlanta, that overvaluation figure is similarly eye-watering, in the 40% range. That's not just a little froth, that's a major disconnect. But FIU aren't the only ones raising the alarm. Moody's Analytics, a heavyweight in economic forecasting, argues that overvaluation isn't just present in a handful of markets. Their analysis suggests that 97% of U.S. cities are overvalued once you compare home prices to local incomes, rents, and construction costs. According to Moody's chief economist, Mark Zandi, many of these markets are stretched well beyond what their economies can support long-term. Moody's doesn't sugarcoat the risks. In the most overheated markets, they forecast potential home price declines of 5 to 10% if things normalize, and even as much as 10 to 20% in a deeper downturn or recession. They're not calling this a repeat of 2008, but they are warning some of this overvaluation is vulnerable to unwinding.
So why should you care, especially if you're not an economist? Because this framework reveals who is most exposed. There are three groups that might be sleeping on a financial landmine. First-time and low-income buyers. If you're buying in a market that's wildly overvalued, you're locking in a home that may not hold its value, or worse, could drop. That's not just bad business, that's a potentially devastating financial commitment. Speculative investors. People who bought during the pandemic boom, hoping to flip or rent out, may find themselves stuck. If price is correct, their returns vanish or even go negative. And anyone hoping to sell or refinance soon. In an overpriced market, resale risk is real. You could be trapped by weak demand later or find that refinance rates combined with inflated principal make it nearly impossible to move. In short, measuring overvaluation isn't academic nitpicking. It's a vital early warning system. These are the signals that scream danger ahead long before the headlines do. Understanding how overvaluation is calculated gives you a superpower. It helps you see through the hype, it protects you from speculative heat, and it allows you to make smarter decisions, whether you're buying, investing, or just staying alert. Because when the market corrects, and make no mistake, some of these markets will correct, the difference between paying 10% too much and 40% too much could be the difference between a manageable loss and a financial catastrophe.
Let's take a look at the top 10 overvalued markets based on the data. Number 10. Lakeland, Florida. According to the FAU-FIU study, Lakeland is overpriced by roughly 34% versus its long-term trend. What's fueling this bubble? Rapid in-migration from other parts of Florida and out of state, coupled with low housing supply and a surge of speculative investor activity. People are buying not just to live, but to flip or rent, betting that Lakeland will keep roaring ahead. But the risk is real. If supply catches up or if demand cools, that 34% premium could shrink fast. And fast is not always fun when your down payment disappears in a crash. Number 9. Orlando and the broader Central Florida region. Think Palm Bay and nearby metros. Here, the overvaluation sits in the 34 to 36% range. This area is booming thanks to tourism, vacation rentals, and a migration wave that never seems to end. But there's danger hiding under the sunshine. Rising insurance costs, think natural hazards, climate risk, and the fact that a good portion of demand is speculative. Investors buying for short-term gains, not long-term roots. If mortgage rates go up, or if the tourist rental market softens, many of these bets could unwind quickly. Number 8. Cape Coral/Northport, Florida. These Sunbelt markets are running very hot, overvalued by roughly 36 to 40% depending on the data source. Massive migration to Florida's Gulf Coast combined with a build-out risk. How much more can they really build before the infrastructure groans? And growing climate vulnerability has driven prices through the roof. But that same vulnerability is a ticking time bomb. Flood risk, rising insurance premiums, and long-term sustainability all threaten to drag this speculative bubble back to earth. Number 7. Knoxville, Tennessee. Here, buyers are paying about 37% more than long-term fundamentals would suggest. Why? Remote workers love it. Affordable land, lower cost of living, and a strong sense of community. Inventory is tight, and that scarcity is driving prices higher. But it's not all rosy. Income growth in Knoxville may not keep pace with the rising home values, and if too many people bought hoping for endless appreciation, a market hiccup could hit hard. There's room to run, but also room to fall. Number 6. Las Vegas, Nevada. The city of bright lights, big risks, and now perhaps overblown real estate dreams. The FAU-FIU data shows 37.5% overvaluation here. During the pandemic, speculative buyers poured in, betting on endless migration and low cost of living, but Las Vegas's economy remains deeply tied to tourism. If rates rise, or if consumer spending slows, some of that housing demand could evaporate. And with overbuilt inventory in the suburbs, the risk of a correction, or at least a flattening, is very real. Number 5. Tampa, Florida. According to the FAU-FIU data, Tampa is nearly 36% overvalued. Population growth is on fire. Everyone wants a piece of Tampa Bay. But with that growth comes risk. Coastal and flood exposure, skyrocketing property and homeowners insurance, and a dependency on continued demand to justify these premiums. If climate risk intensifies, or if insurance becomes unaffordable, a market that once looked like a golden opportunity could quickly feel more like a minefield. Number 4. Charlotte, North Carolina. Homes here are about 35% over their modeled long-term value. The city has become a magnet for tech and logistics, drawing in high remote workers and high-income earners. But the rapid growth comes at a cost. Infrastructure strain, possible overbuilding, and affordability constraints that could erode the very demand that fueled this boom. If interest rates tick higher, or if workers decide they can't afford to live in Charlotte long-term, the market could stall. Number 3. Detroit, Michigan. This is where things get tricky. Detroit's housing market is 40.79% overvalued, according to the FAU-FIU study. Why the spike? The main driver is new household formation, people leaving shared housing, forming their own households, even though the city's population growth is relatively stagnant. There's demand, but it's not bolstered by massive in-migration or booming corporate growth, so the supply is under strain. The problem is that Detroit doesn't have the economic engine of a fast-growing Sunbelt city. Income inequality is deep. What happens when buyers who paid a 40+% premium face stagnant wages and limited job growth? There's a serious risk. Either prices plateau painfully or they retrace sharply. Number 2. Atlanta, Georgia. Atlanta is nearly 40.4% overvalued, according to the same FAU-FIU data. This is a city that exploded during the pandemic. Huge inbound migration, sprawling suburbs, long commutes, and a belief that growth would never stop. But that bet has costs. Infrastructure is being pressured, and many of these new buyers came at the peak of low interest rates. If rates stay high, affordability sours. If commuting costs rise, people may rethink staying. And if demand slows, resale risk could bite hard in neighborhoods that were once hot. And now, number 1. The big one you might not expect. Boise, Idaho. According to Moody's Analytics, Boise homes are 73% overvalued relative to fundamentals like income, rent, and construction cost. Yes, 73%. A massive premium that suggests the market may be built more on narrative, like Boise is the next tech hub, than on economic reality. What's driving it? Remote workers fleeing California, real estate hype, and a belief that Boise's growth is bulletproof. But the risk is enormous. Moody's warns that in the most overpriced metro areas, prices could fall 10% or more in the coming years. That's not just a soft landing. In a downside scenario, many homeowners could be underwater or stuck holding homes nobody else wants to buy at these peak prices. Having laid out the list, notice a pattern. Many of the most overvalued markets are in Florida, or fast-growing Sunbelt or suburban metros, or secondary cities like Detroit and Boise. The common thread? Speculative demand, plus rapid migration, plus constrained supply. But the underlying risk is not the same in every city. In Florida, climate risk and insurance costs could erode the thesis. In Las Vegas, tourism dependence becomes a weak leg. In Detroit, fragile incomes and slow economic growth may not support these inflated values. And in Boise, well, you're paying narrative risk more than anything. These aren't just rich people markets or wealthy tech hubs. These are markets that could be structurally vulnerable if things change. If credit tightens, migration slows, or supply overshoots, some of these premiums may simply vanish, or worse, reverse. For buyers, this means enormous caution is warranted. For investors, it means stress testing every deal, every assumption, and every exit. And for policymakers, it means grappling with how to build resilience, manage growth, and mitigate the fallout if correction comes. Because being in one of these highly overvalued markets isn't a badge of honor. It could be a risk sitting quietly under your own roof.
There's a strange moment happening across the country, where cities that were once considered bargains are now sitting at price premiums that would have sounded like satire even 5 years ago.
And if you want to understand how we got here, it helps to zoom in to specific places that look fine at first glance, and then feel a little like a tall Jenga tower 3 turns before collapse. Let's start in Detroit, because Detroit right now is in its own renaissance, recovery, reinvention, and identity crisis all at once. For years, local families and first-time buyers saw Detroit as the last bastion of affordability in the Midwest, the final frontier of reasonably priced houses. Investors saw it too. In fact, they saw it first. They brought spreadsheets, auctions, crews, and the belief that everything would double eventually. And then homes that set at $85,000 just a few years ago suddenly demanded $200,000, sometimes with descriptions like needs electrical, plumbing, foundation work, and imagination. Buyers rushed in anyway, terrified to miss the next great American comeback story. But Detroit is now one of those markets where the romantic optimism collided with economic reality. Yes, jobs have returned. Yes, development is happening. There are entire blocks you couldn't pay people to move into in 2014, where bidding wars are now normal. And yet, beneath that glossy top layer, the cracks form quietly. Incomes that aren't rising fast enough, property taxes that make even renovated homes feel heavy, and neighborhoods where renters face sudden 30 to 40% hikes overnight. The investors who arrived early are thrilled. The ones showing up now are nervous. And the families who bought emotionally instead of financially, they're sweating the mortgage calculators every month. Then, Las Vegas, the desert mirage of affordability. Vegas has done something astonishing. It convinced millions of people not just to visit, but to move there for good. It became the escape hatch city. You live in California? Too expensive? Vegas. You need remote work sunshine? Vegas. You want to feel rich without actually being rich? Vegas. But Vegas real estate behaves like Vegas nightlife. Wild, glamorous, enthusiastic, until the lights switch on and everyone realizes the bill is due. The city saw investors piling in during the low interest rate boom, scooping up entire neighborhoods like they were coupon items. Californians arrived with cash offers. Locals watched prices sprint past income growth like it was a track event. The fascinating part is that Vegas often rises faster than the national market and falls faster too. Booms get big, corrections get brutal. The tension in the market now is this unspoken question hanging in the heat. What happens when the speculative money dries up? What happens when demand cools just a bit and suddenly supply looks heavier? The truth is, in Las Vegas, people still believe this can run forever. But the people who lived through the 2008 collapse don't feel that way. They remember what it looks like when a market stops mid-stride. And so, quietly, very quietly, homeowners who bought at peak pricing are starting to whisper that scary word again: shortfall. And then you have Boise, Idaho, the spiritual capital of how did we get so expensive so fast? Boise used to be the place where you could start a life without bankrupting future you. It was calm, affordable, slow, steady, predictable. Then 2020 hit, remote work exploded, and Boise became the poster child for pandemic migration inflows. People arrived with larger salaries from expensive states, waving cash offers like golden tickets. Locals were stunned. Homes that set comfortably at $280,000 one year suddenly blasted past $500,000. Prices rose so fast that residents who had lived in Boise all their lives suddenly couldn't afford their own city. Everything escalated. Renters were crushed, developers rushed in. The housing narrative changed from Boise is affordable to Boise is the new blue-chip market of the Mountain West almost overnight. But here's the emotional core of Boise. The boom felt exciting until it felt excluding. Now families who moved there for peace and affordability find themselves squeezed by rising taxes, insurance, and utilities, the slow, creeping cost no one includes in the listing price. And many are quietly asking if the premium they paid was for the house or the dream. What ties all these cities together is the same ghost in the room: rapid price escalation based on the belief that demand is endless. But demand is never endless. It is seasonal, cyclical, human.
And what's happening now is that buyers are waking up one at a time, realizing they might have bought it the wrong season. The retirees who fled colder states for Florida planned for sunshine and savings. Instead, they got insurance renewals that look like lottery jackpots running in reverse. The young couples who believed they could grow into their mortgages didn't expect grocery bills to compete with their monthly housing payment. And the investors who once expected guaranteed rent increases are now discovering tenants have breaking points too. These case study cities reveal something uncomfortable under the surface. Real estate isn't just numbers and prices. It's fear and hope and urgency and envy. It's people chasing a future version of themselves. And when markets become overvalued, that dream gets heavier. Suddenly, the home is not just shelter. It's risk. It's exposure, it's vulnerability disguised as achievement. And when prices sit far above fundamentals, the market doesn't need panic to correct. It just needs gravity. Some cities rise longest, some cities fall hardest, but every overvalued city eventually loses its balance. And that's when the truth arrives, quietly, like a text you don't want to read but can't ignore. Maybe this wasn't affordable after all.
The truth is, no one knows exactly how this plays out. Economists at FAU admit it could go two very different ways. A soft landing, where prices cool slowly and drift back toward fundamentals over several years. Or the sharper version, where confidence breaks quickly and markets correct with force instead of finesse. And neither option feels especially comfortable if you're the one holding the mortgage. The biggest risks aren't hidden anymore. They're right in front of us. Interest rates that turned a starter home into a luxury purchase. Insurance costs in coastal and Sunbelt markets that double without warning. Climate threats quietly reshaping risk maps. And affordability metrics that look like they've been stretched to the breaking point. Even if there is no crash, the burden itself is heavy. Families already feel it. Buyers stretch further. Savings shrink faster. Repairs get postponed. A roof leak becomes a quiet financial emergency. And the dream of homeownership, for many, shifts from freedom to an ongoing calculation of sacrifice. Overvalued markets don't need to collapse loudly to cause damage. Sometimes all they need to do is stop rising.
Cities are realizing that growth at any cost is not a strategy, and certainly not a sustainable one. When homes become financial instruments instead of shelter, communities destabilize. Planners and policymakers are now being forced to walk a tightrope, encourage development but prevent bubbles, attract newcomers but protect locals, expand supply but not just in the places investors prefer, and all while building housing that can survive stronger storms, higher insurance premiums, and the next unexpected shock. For buyers, this moment demands caution, not fear, caution. The danger is believing the hype more than the math. Don't over-leverage just because everyone else is stretching. Plan for your actual income, not your someday income. Buy a home you can afford even if appreciation slows or stops or reverses, because that's where safety lives. And for investors, the risk is different. It's not missing the upside. It's being trapped in the downside. Stress test deals like gravity is coming, because if the correction hits, the winners won't be the boldest. They'll be the ones who prepared for boring realities.
Overvaluation isn't just about prices being high. It's about markets drifting away from reality. It's about households being stretched too thin. It's about a system hoping momentum will solve what fundamentals can't. And that is the risk we have to acknowledge. If you take anything from this, let it be this. Don't follow excitement. Follow value. Look past the marketing, the speculation, the fear of missing out. Look at wages, insurance, taxes, inventory, demand, and long-term stability. That's where truth lives. Because for the people paying these mortgages, this isn't a headline, it's their life. If you want to stay ahead of this story as it unfolds, subscribe, follow, and stay close. We'll be tracking these markets, the data, the shifts, and the turning points, and we'll be here when the next signs appear. And let us know, what changes do you see coming in the 2026 real estate market?